What is backflush costing? Backflush costing is an accounting method where costs related to materials and production are recorded only after the production process is completed, rather than during each stage of production. This approach avoids frequent journal entries for work in progress and raw materials, instead consolidating these entries into a single transaction at the end of the production cycle. This method is especially useful for organizations with complex manufacturing processes and high production volumes. In backflush costing, a standard cost is assigned to each product unit. Once production is complete, the total cost is calculated by multiplying the standard cost by the number of units produced. This total cost is then recorded in the accounting books. The process begins when an order is received and necessary raw materials are listed and moved to the production floor. Upon completion of production, a production report is generated, and the material costs are recorded in a single journal entry. The journal entries under backflush costing typically include debiting the finished goods account with the production costs and crediting the respective accounts for payments or purchases. When the finished goods are sold, the cost is transferred to the cost of goods sold account, and the finished goods account is credited. Backflush costing differs from conventional costing, where raw material costs are recorded separately at each stage, first in raw materials inventory, then in work in progress, and finally in finished goods. Conventional costing also records overhead and labor costs in the work in progress account before moving them to finished goods and cost of goods sold. In contrast, backflush costing consolidates all production costs directly into the cost of goods sold account. This costing method is particularly suited for companies with high turnover and low inventory holding periods, simplifying accounting for complex production processes. However, it may not be appropriate for companies with slow inventory turnover or those dealing with significant production variability. Backflush costing is not always in line with generally accepted accounting principles, GAAP, and may not account for scrap material, potentially leading to inaccuracies in financial reporting. Despite these drawbacks, its benefits include simplified accounting processes, reduced need for frequent updates, and easier cost assignment.